Hello, it's Friday the 18th of February. I'm Jessica Hines, Senior Europe Economist at Capital Economics, and this is your week in review. This week has been dominated by developments on the Russia-Ukraine border, and we've spent a lot of time thinking through the economic implications of a further escalation of tensions and/or a ratcheting up of sanctions. All of our work on this can be found in a dedicated section on the homepage of our website, so please do check it out. Some key points have stood out. The first is that, as our Emerging Europe economists explained this week, Russia's economy is much better placed to weather Western sanctions than it was in 2014. It's got much less in the way of short-term external debts and much more in the way of foreign exchange reserves. Ukraine too is better placed than it was, but is much more vulnerable than its neighbour, and perhaps not surprisingly, a big depreciation of the currency would spark concerns about the country's debt sustainability. The second point is that whether Russia invades or not, the flare-up of tensions is likely to speed up the process of Russia's decoupling from the West and in the direction of China. And the third point is that spillovers to the rest of Europe are on the whole likely to be quite limited. The biggest potential impact stems from higher energy prices. Our chief commodities economist, Caroline Bain, estimates that in the event of a Russian invasion, oil and gas prices could easily double temporarily. And this could add as much as 2 percentage points to inflation in developed markets, particularly in Europe. Even without a Russian invasion, price pressures remain uncomfortably high in developed markets. In the UK, inflation once again surprised to the upside in January, and our UK team are forecasting it to peak at close to 8% in April. In the Eurozone, wage growth has so far remained much more subdued than in either the US or the UK. That's in part being due to the faster and fuller recovery in the labour market. But as I argued in a note published earlier this week, the Eurozone's labour market is now looking increasingly tight, and consistent with a pickup in wage growth to over 3% over the next couple of years. The prospect of rising pay pressures will probably allow the ECB to feel sufficiently confident about its medium-term inflation outlook, and it will start gradually normalising monetary policy later this year. We expect the bank to start raising rates in the second half of 2022 and for the deposit rate to peak at 0.5% next year. But that would still be much lower than the peaks we expect in both the US and the UK, as our senior economic advisor Vicky Redwood explained in a Global Economics Focus earlier this week. That's all from me for this week. Thanks very much for listening and have a good weekend.